Good morning. Welcome to this month's ASIS Economist Board, where we're going to discuss current economic conditions as it relates to industrial production. Each of our production models covers or utilizes about 18 to 20 economic indicators with data going back over 20 years. And in this video, and then the related subsector videos that we're going to do, we're going to take a look at what's driving each one of the models and how it relates to what we're seeing in the real world. I'm John Nelson with M&A. I'm joined by Keith Prather of Armada. How you doing, Keith?
Doing fantastic. Looking forward to this.
You ready to get going on this?
Do it, man. Let's roll. Let's get right into it.
All right. So I need you to, actually, no, I'm going to share my screen, aren't I?
Yeah, there you go.
So I'm going to go ahead and share my screen. Okay, first thing we're looking at is the overall index of industrial production for manufacturing. And here's the forecast for November, and it's really not much of a different forecast at all from previous months. If you look at the scale, it's almost exactly the same from one month to the next. Maybe a little bit of a steeper drop, but you're talking a point or so initially. But the story remains the same for industrial production for manufacturing. We got this upcoming dip that's going to take us into this coming summer, where we're going to start the turnaround.
Yeah, and I think this, again, we've said this before, but this really follows a lot of the economic forecasts where we've got a first half cooling off, maybe a mild recession, shallow, followed by, I'm seeing some forecasts saying that maybe that weakness pushes all the way maybe into Q3 a little bit now. But it's not deep. It's not deep. It's not substantial. It's not a really sharp recession, but enough pressure like in the housing market and maybe enough layoffs starting to take place that you start to feel a little bit of that recessionary pressure. So anyway, you see that, and then we're getting this weird little tail on the back end of this, which again, we started to see it last month. You can kind of see it in the chart on the right, but we're starting to get a little bit of that trail off. And there's a little bit of uncertainty kind of now building in 2024, and it's largely at the hands of the construction sector. And we'll talk a little bit more about that later, but it has to do with interest rates and the fact that in 2023, some of the market is going to be boosted a little bit by projects that have been put on hold that will be kind of moving through to completion. So you think about projects that have been stalled because they can't find the right labor, they can't get enough raw materials, they can't get the components that they need. As those become more available as we go into a recession period, that's when we're going to get these little, like we call them green shoots, but it's going to be these little pockets of growth that are kind of hard to explain. And the construction sector is going to be one of those areas where we're going to get some of these little pockets of growth, and it's mostly on the commercial side. But when we think about manufacturing, a lot of the manufacturing sectors, a lot of manufacturing output is driven heavily by the construction sector. So that's why we're getting a little bit of this boost in 2023. But what we're hearing from developers is they're concerned about 2024 because a lot of these projects that are currently underway will move to completion in 2023, but higher interest rates may stall that next wave of brand new projects coming into 2024. And so we'll continue to watch this tail, but again, seeing that tail come on and see that tail kind of starting to show a little bit of a dip, starting to tell us a little bit of a different story for 24. So we're going to watch it.
All right. And let's take a look at over long-term. Again, picture hasn't changed much. I think the one thing to note is dip is it's not out of the realm of what we have seen in the past. When you look at the recession back in 2001, it's about the same scale of the dip is that we saw way back then. And then we've had other similar dips. Even just prior to COVID, we were experiencing something that was pretty close in scale to what we're seeing right now.
Yeah, and obviously we can see this is where we get sort of the reading of a shallow, downturn, only because it's just not as pronounced and as deep and as steep as what we saw in 2008, and then obviously during the lockdown we had in 2020. So, but you're right, John. It really starts to. It's almost like the model's grabbing that 2001 curve and kind of repeating it, but we know that's not the case. It's just It's interesting because it is starting to look and feel a little bit like that. And again, it's interesting if you look at the blue line is obviously actual, and right now it's the model we still see industrial production increasing, moving up a little bit. So the model's kind of saying, hey, still expect maybe the worst to come. Hasn't really hit us yet, even though we want we want to feel like maybe some of the bad news that we've had in the economy is starting to lift just a little bit. We're starting to get a little bit of hints of some inflationary pressure that's easing, and sentiment and consumer optimism is starting to improve just a little bit. We're kind of beyond the midterms, and typically that kind of ushers in a little bit of a wave of optimism. And the models are still showing something counter to that, and so they're kind of warning us again that we need to batten down the hatches a little bit more, because again, some of the worst is yet to come. So
again, and for a few months, yeah, you're going to see exactly what you were saying. But by the time a year rolls around, we're back up to right on trend.
Sharp recovery, sharp back half recovery. And that's going to be critical, especially for people who are trying to run supply chains and trying to manage raw materials, and to know when to build those inventories, and when they're going to go start borrowing. A lot of those decisions are going to be made based on what that back half of 2023 feels like. And if we do get this sharp recovery, like the model is showing right now, you're exactly right. It's going to create a really interesting environment on that back half.
Sure. Here's the year over year, and I don't know that it really offers any great additional insights over what we've been talking about, but you do see with the dash line moving across the center, that being our forecast for coming months, you can clearly see how it just kind of scoops out, but not way too far below much of the historical level, and starts coming right back into where you're seeing other years.
Yeah, I mean, the only thing I would say here is for you and I is kind of a gut check moment, right? Because you look at that black line representing 2022, and you could argue that, wow, we're stronger than we have been over the last 7 years,
Right.
and it's still trending up. And you and I are, the model is calling for, again, that sharp downturn. So for you and I, it's kind of a gut check moment.
Yep. So let's take a look back in the supply chain a little bit further back, and go all the way back to the raw materials, into our primary metals. The story here is remaining roughly the same, although I will tell you, if you look at it closely, this is about a 5-point improvement over last month's model. You still have that dip. It's still trending a lot, where industrial production is kind of the same time frame that you talked about, Keith, where it dives into through the first 2 quarters, and then maybe a little bit of weakness in the third quarter and coming back.
Yeah, so I'm gonna go outside the models for just a second. And right now, worldwide, when we look at commodities and you look at commodity inventories, we are still seeing not historic lows, but we're seeing multi-decade lows in things like aluminum, nickel, copper, zinc, lead, some of those primary metals that go into a lot of manufacturing activity. And so that's, I think, a little bit of helping that model kind of soften some of the dip. And so we know that coming in, if I'm getting ready for a second half of 2023, and companies are starting to order some of these primary metals to start going into, finished production of like automobiles and aerospace and machinery and all those other industries, I've got to start pre-ordering that. And so the model's kind of showing a little bit of that pre-ordering cycle, at least for now, and how it's improving a little bit going into the middle part of next year. So again, if you're watching those cycles and you're watching recovery curves, you're going to want to watch this sector, because we're starting to see that recovery a little bit quicker. I think if China releases more COVID restrictions than it has over the last 2 weeks, and you start to see Chinese demand for a lot of these raw materials start to inch up, it'll also accelerate this. And then the last thing I would just add is that by March of this coming year, Europe will start to emerge out of its winter solstice, and it'll start getting into warmer spring weather, which means its current challenges because of energy shortages and higher energy prices starts to ease. And so you start to see the industrial sector in Europe start to come back to life a little bit. So that'll be kind of as we get into Q2 of next year. And so again, it kind of creates a lot of this commodity pressure again across some of the global economy. I just think we have an opportunity to see commodity prices continue to dip because demand is so weak right now. But just watch as they start to recover, as demand starts to recover, because we are still sitting on really low inventories on a global basis on a lot of these metals.
So something I wanted to kind of point out is that on this chart, you start to see it here, but if you note, our high on this chart, and we're only looking back a little over a year, is sitting around 100 back and around in October of 2021. We never recover that. Unlike industrial production for manufacturing, our recovery on the backside of the recession actually starts exceeding it and showing a little growth. You can see that a little bit in the long-term trend about this particular commodity, reverse of what industrial production shows in general, and that is, an overall decline in that. Do you want to comment on that?
Yeah, it is interesting. I do think based on what we're seeing again with those global inventory trends, that I think this model has a potential to be a little more optimistic as we move forward over the next several months. And we start getting more of those clear readings. We take nickel, for instance, and nickel goes into a lot of stainless steel, but we're also using a tremendous amount of it, and we'll continue to use more of it for EV battery production. And right now they're calling for maybe some global nickel shortages, and it's going to create some challenges. And so I do think that this curve will improve over time, but you're exactly right. Even with the recovery, back half of this going into 2024 was still well below that long-term 20-year trend. And we'll see. Now, a lot of this is going to be U.S. output, and I know we are importing a lot of primary raw materials still. And I think that could be weighing on it a little bit. And you see a little bit of that offshoring trend that we've seen in other industries kind of start after the Great Recession, and we continue to offshore a lot of it. And I think that may be why we see these longer term trends of this downturn. But again, we'll kind of see what happens over the next the next couple of quarters.
So let's bring it in a little bit closer. I don't think the year over year is showing as much of a different story, but I want to do a little bit closer in on the supply chain into our fabricated metal. And this is showing a little bit, it's certainly a little bit more optimistic than what we have been showing, where we showed it looked like something that we came out of a water park, one heck of a slide. But now we have kind of this more general trend downward, but not so far down. When you take a look at it in terms of scale, we're where we were at a high of about 102. Our low is still only 97. So we're talking about a 5% drop, kind of sustained over the next 18 months.
Yeah, I mean, if we were to carry this out and look at it longer term, and we will in a minute, but it's going to look almost like a flat line. There's just not a lot of variability here, which is good, because that's what this industry needs to be able to forecast, predict, staff, bring on talent, keep folks producing. But it looks like, at least again, more of a shallow recession risk, which would mean that there's maybe more of a stable demand environment moving forward, obviously, as the model's showing. And I can tell you that things like consumer sentiment and some of those measures that have improved are not some of the economic equations that go into the models themselves. So these models are picking up other hints of optimism and improvement in the corporate operating environment, new orders, some of those factors that are driving demand. And so this, to me, is really optimistic. And I even though it's still showing it down, it's not showing a growth trend, much better than what we were getting, as you said, a month or two ago.
Sure. And if you look at long term, again, like primary metals, it's kind of showing the overall trend line down, over the 20 plus year period in this case. But this model also shows tremendous swings one way or the other in the history of it. And right now, if you take a look at what the things that we're looking at, they actually look rather mild compared to some of the years that were time frames that we've looked at in the past.
Yeah, and again, that movement and that curve is mild, but it is still, we're still predicting, the model's predicting going from an environment where fabricated metals are doing pretty good to a real period of softness, stretching into the middle of next year. So again, kind of using the nomenclature, the worst is yet to come. It kind of feels that way. But again, as we both pointed out, you look at that, we went from 120 points down to about 85 points, a swing of, it was at 35 points during the Great Recession.
Right.
And then even down, during the lockdown, we moved from about 100 or so points, down to about 85 or 87, I guess. And we're not calling for anything that dramatic at all. And so it's going to feel again like a flattening.
And even in 2014 to 2015, or actually 2016, that's a 10-point drop,
right,
compared to what we're looking at, about a 5-point drop.
Right. And what's interesting about that drop was we actually had a transportation recession. So
Hmm,
at that time, we did see year-over-year transportation rates for about 2 years really plummet at that time. And so there's pressure out there, and it's going to create economic pressure and some challenges, but nothing dramatic like we've seen historically. So companies that are trying to make cost decisions and trying to figure out how to trim their costs to be able to get through this next downturn, they may be looking at things that don't look like labor for the first time. Most recessions, it's pretty easy to reduce headcount and get some of your cost controls that way. And this time, in this particular recession, we may not see those kinds of cuts being made just because it's so hard to recruit and attract and retain staff now.
right.
So, we may be seeing some cost cutting in some different types of areas.
Okay. Well, that completes our look at the high level of industrial production plus, up in the supply chain, leading towards it. So we hope you've enjoyed our look this month, and we will see you again next month.
Sounds good. See you guys soon.